I did many videos on Disney in 2023. I was kind of bullish on the stock where it was trading at around $85, $84. I said it's over 78% on the upside for Disney stock. And this is a video that did not get a lot of views. And I was bullish on Disney going into 2024. I said I wouldn't be surprised if Disney and PayPal end up being the best performing stocks of 2024 because we have a new year, new sentiment, new winners, and both of them had new management where we could have some kind of a change in sentiment. And this has so far played out for Disney. As you can see in this chart, Disney is up over 21% year to date, but PayPal has not been playing out of this earnings report. It's down around 8% year to date, but for Disney, it is playing out. The stock is now sitting at $110 per share. It's starting to recover. It still could go up much, much more. But I'm going to do a very quick earnings review in this video, and I'm going to tell you why I believe Disney stock is getting a little bit ahead of itself. In this reversal, I like to see it. I like what I'm seeing in earnings and from the new CEO. Massive change from the previous CEO. But I believe the stock is getting a little bit ahead of itself in terms of what the CEO is planning. And I'm going to tell you why here in this video. Now, for earnings, they were pretty good, $1.22 versus 99 cents expected. Pretty good on EPS per share. Revenues, they missed a little bit, but it wasn't a big deal, not a big miss or anything. Guidance was very good for the 2024 EPS per share, around $4.60, which was 20% higher than 2023. After having 2 or 3 years of a massive contraction in EPS and free cash flow, now it's finally shifting. The tide is shifting to the upside, and now we have 20% growth in 2024, which is very good. I mean, amazing stuff. If you look at the recent report, revenue was pretty much flat from Q1 of 2023 for Q1 of 2024. But if you look at profitability, income before taxes, they're up a lot. Segment operating income is up a lot. EPS is up a lot. Diluted EPS is up a lot. So profitability is up way more, even though revenues is still the same. And this is thanks to the massive cost-cutting initiatives the CEO has done. He cut off a lot of films, a lot of projects that have been performing. He did get rid of some, employees that they were not needed for the job, and he cut a lot of cost. I believe it's around $4 billion so far, and his goal is around $7 billion in total, which is pretty astonishing in terms of DTC, direct-to-consumer quarterly operating income. It has improved. It's been an operating loss from over $1 billion of loss to now only around $100 million of loss. I mean, this is a massive, massive improvement. Disney Plus could be profitable in Q2 of 2024. Pretty amazing. I mean, they came so far. The new CEO is amazing. He's doing pretty good things. And we can clearly see the improvement in terms of, losses with DTC that has the potential to turn profitable. But there's a few things that the market didn't like, and I personally didn't like, and it's mainly Disney losing subscribers again. Last quarter, they lost some subscribers, but international subscribers offset the losses because they grew massively in Q4, as you could see here in this chart. But what happened in Q1 of 2024, both of them declined. Domestic subscribers, the core subscribers they call it, and international subscribers, excluding Hotstar, which is the Indian cricket kind of thing, they also, despite it, they also declined, which is not good. If you look at this trend from Statista, it does not include Q1, which is lower than Q4. But you could see the trend. It has stopped in Q4 of 2022, and it has been declining since then. But you have Netflix and many other providers. They have still been gaining subscribers, and they still have been profitable. But Disney Plus looks like it has peaked, and it has been declining since then. Some of it has to do with Hotstar, of course, but even the core subscribers are starting to decline. And I think this is because the CEO is trying to focus more on profitability than just having as many users as possible. He had to hike the price a little bit, and maybe that pushed off some people. They couldn't afford it. They chose Netflix, or they chose something else. But he's trying to prioritize profitability over just having a lot of user growth without having any profitability from that, which I believe is a smart thing to do. But I hope he can somehow, balance out gaining users and also being somewhat profitable. I think he might be able to do that a little bit in the future. He has a lot of different things coming along in 2024, 2025, 2026, Snow White, and many Frozen, and many different things that you're familiar with, pretty popular Disney franchises. They also invested over $1.5 billion in Epic Games, which would give them a partnership with Fortnite Studio to create new games and entertainment universe where consumers can play, watch, shop, and engage with content from Disney's character like Marvel, Star Wars, Avatar, and many others. This is very smart. I think it's going to be very successful. I think it could draw a lot of people to Disney. Maybe it has something to do with Disney Plus, and maybe then the CEO can eventually start growing users again while maintaining some kind of profitability. I'm not sure if they overpaid for Epic Games' $1.5 billion stake. I don't know how big the stake is, and I don't know the valuation of Epic Games because it's a private company. If you know anything about it, you could let me know in the comments. I would love to know. But I don't really know anything about Epic Games, but I would guess that they most likely overpaid for Epic Games, just out of guess. This is what normally these companies do. They get a little bit desperate and they tend to overpay to get exposure to compete in something, and they're trying to go after Netflix and trying to compete with games, which I believe is a very smart thing to do. They increased the dividend by over 50%, and they are targeting a $3 billion share repurchases in fiscal 2024, around $7.5 billion, $8 billion of free cash flow expected for later on. Now, I have to be honest, I'm not a big fan of the dividend, and I'm not a big fan of the buyback program. I think the best time to buy back was last year, and the best time to do dividends was way before now. I don't think now is the time to be increasing the dividend and doing buybacks. I think this is the time to be paying down the debt, to try to grow the core business instead of trying to return value. The best values they can return to shareholders, and if they reinvest and acquire other things to try to grow users, try to grow free cash flow, which the CEO is doing in terms of cost cutting. But there's only so much cost he can cut. And after that, how is he going to grow revenues, which are still flat from the previous year? So this is my only question to the CEO. But they do have a lot of debt. In total, it's pretty close to $60 billion of debt. So they have $60 billion of debt. They are paying around $1.9 billion in interest expense every single year. This is what I would have been focused on. I would have preferred the CEO is a little bit more focused on paying down the debt, reducing interest expense, which will increase free cash flow. And then he can use whatever they save on interest expense to increase the dividend by 20, 30, 40, and 50%. But this is what the CEO has chosen to do, and so far he has been successful in the things that he did. So I'm not betting on him. I would have preferred if he did something a little bit different for shareholders of Disney. But in terms of free cash flow, they are still expecting $8 billion on track for 2024. This would be a massive improvement from $1 billion in 2022. Disney used to be a free cash flow generating machine, 8.4, 8.7, 9.8 billion. Then I started Disney Plus and other things too, and this is when free cash flow went from pretty close to 10 billion to 1.1 billion, absolute disaster. Well, now we're getting back to 8.1, and the analysts are expecting around 10.5 billion by 2027. This would be massive improvement, massive free cash flow growth over the last 3 years. But you have to set your expectations a little bit low, because this has been mostly due to cost cutting and unprofitable things becoming profitable. This is not going to happen every year. So it's going to be a little bit slower from here. But analysts are expecting 10.5 billion by 2027, which I believe is achievable. Now, here's why I believe Disney stock is getting a little bit ahead of itself, is because, yes, the CEO is doing good things. Subscribers are declining, a few more things, but in total, things are improving, and things are much better than they used to be last year, much better than it used to be in 21 and 2022, and the stock has responded to it. It's up, I believe, 24% year to date. But if we look at just basic calculations, and let's assume the analysts are right, around, let's take $10 billion of free cash flow for 2027. And we look at where Disney used to trade at on a mean multiple of market cap to free cash flow before COVID, which I believe is more stable. If you look after COVID, the things is all the way up and down. And there's a lot of different things that really makes it look much, much higher because of 2021 and 2020. So there's a glitch in the system. But if you look at pre-COVID mean multiple, it's pretty close to 20 times free cash flow. Now, if you take the $10 billion expected and you time it by 20 times free cash flow, this is close to a $200 billion market cap. Well, the market cap right now is at $181 billion. Just taking on 20 times free cash flow, and free cash flow going to 10 billion, there's pretty much no upside on Disney other than the free cash flow yield, which is pretty close to, I believe, 4% or 4.5%. So there's not much upside potential on Disney. Unless Disney gets to a market cap free cash flow multiple of 30 times, then you could see 50% upside over the next 5 years, which is not bad, but it's not enough for me. So the way I look at Disney, I think the CEO is doing well. he's improving things. Things are going into the right direction, of course, but I believe the stock is getting ahead of itself. It doesn't mean I'm shorting it or I'm trying to bet against it. It could go much, much higher, but I would personally not buy it here if I did not have a position in Disney. If I did have a position around $85, $90, I think this was an amazing time to be buying. This is when I was bullish on the stock, but at $110 per share, I think there's more downside than upside, just my personal opinion. Although the stock could go higher, it could go to $150. I mean, I don't see why not, because things have been improving. Free cash flow is going to be much higher than ever. So if the market gets irrational again and you have much higher free cash flow at a peak multiple of 40, 45 times free cash flow, Disney could be making a new all-time high. I would not be surprised. But I would just not bet on it. And I think the stock is getting a little bit ahead of itself. And this was my analysis on Disney today. It was not financial advice. So thank you very much for watching my videos and supporting the channel. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.